Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about STEM Inc., which trades under the ticker symbol STEM, because they just had recently their Investor and Analyst Day, and this occurred back on September 28, 2022. I'm going to have the full presentation available in the description down below, and I'm going to be walking through some key highlights that I think are pertinent. Let me know in the comment section down below what additional feedback or questions you have as it relates to STEM. Apologies for the delay in this video, but I've been doing some travel and I'm just back in the saddle and able to walk through some of the presentation after I've been able to dive in. So let's get started. As we go through this, again, I want to highlight that there are a ton of different speakers and some information in this video. I would highly recommend going back and actually listening to the presentation. There's some great information in there. But for the purposes of this video, I'm going to primarily be focusing on the overall market outlook, and I'm going to tie in the financial component. So a lot of the technical or product capabilities will not be in this video, and you'll have to let me know in the comments down below if that's something you'd want me to provide. Again, I strictly view this stock more so from the competitive capabilities, the financial strength. I am by no means a software developer, which is the key value add associated with STEM. As such, I have not been diving as deep into the capabilities of the platform. So let's dive on in. So the first thing that I would call out is you can see that there's been a big push in the narrative, and you'll see that throughout this presentation, to drive to positive EBITDA. You'll notice that they are not saying profitability. At no point in time have they said that they are going to be profitable in 2023. However, they have said repeatedly since the original SPAC presentation that they are going to be positive EBITDA in 2023, and they continue to highlight that. The reason I expect they're going to continue to highlight that is due to the current market conditions. We are currently seeing a big push or a negative aura associated with any company that is not currently positive from a profitability perspective. And STEM is not only not profitable yet, but they don't intend to be profitable for at least 18 more months. The expectation is that they will see profitability in 2024. So why is that so important? The biggest thing I would call out is STEM right now benefited immensely from the Inflation Reduction Act, which they showcase in this presentation. However, they also have a lot of pain associated with the fact that they are non-profitable tech-battery hardware, both of which have done very poorly over the past few weeks as the market continues to understand the impact of increasing rates, of tightening balance sheets, and of a potential recession in the future. That being said, I still think that there's a lot of potential for STEM under these levels if your investing highlight or timeline is farther out. I don't think this is a 12-month play. I'm viewing this continuously as a 2025 plus play, but that is by no means financial advice. That is just the opinion of some guy on YouTube, who, if you like the video, please leave a like and subscribe. But back to the video and the company. You can see the company continues to perform exceptionally well, continues to grow revenue, which is the important metric, and bookings. The expectation is this year they are going to hit $1 billion plus in bookings. You can see in the items right here, we're showing high and low ends. So this blue is the low end, the green is the high end. The company is continuing to perform incredibly well by revenue and bookings growth. The important thing to note is, are they going to be profitable? You'll see that trend repeatedly in this presentation. The big push here is they have changed or they have adjusted from a more smaller project basis to really going after their largest projects where they can A, recognize that revenue, and B, start bringing on those large-scale software contracts, which they're going to be able to recognize much quicker and have the much higher profit margins associated with it, which you can see is the target goal based off of that 15 to 20% long-term EBITDA margin. I do think it's important that they did reaffirm 2022 guidance. However, I do want to call out that they reaffirmed 2021 guidance and they had a big miss on revenue last year. The reason I bring that up is because you have to make sure that you're holding the executives accountable, holding the company accountable when they make statements, particularly associated with forecasted components. If they miss on the 2022, It's important to note that this presentation was done at the end of September, where Q3 is wrapped up, and that means that they should have these numbers essentially, or at least clear line of sight to what the end of the year looks like, especially as it concerns revenue. So I'll step off my soapbox stand at this point in time, kind of dive forward. There's a lot of information in here. I'm going to skip the technology and operational excellence, and we're going to dive on down to the commercial strategy. Again, a lot of that other information is highly associated with the product. Feel free to dive deeper into that information on your own time. It's important to note, as I highlighted, the software is the big gross margin provider. That is why STEM continues to hold somewhat of a premium compared to other players in their space, such as Fluence. It's also important to note that their big contracts, the ones that bring in the big revenue dollars, are still the hardware, the battery installations. It's also nice to note that that continues to perform very well from a cash purchase perspective. And then I would also highlight that you can see that from the other platforms outside of the batteries is where they get the positive gross margin. The nice thing there is you can recognize that revenue much more quickly than hardware, where that could be anywhere from a 6-week to 1 year build time. The other thing that I would highlight is they have a lot of important customers. They are breaking these out between BTM, behind the meter, and FTM, front of the meter. The difference is primarily where you're going to have your system in regards to the electric meter. So front of the meter is, generally speaking, going to be at scale. It's going to be larger companies. You're going to see this in a lot of utility providers, whereas a lot of the customers that you see here and the approach that you have here is going to be associated with energy storage, residential solar, or potentially fleet EVs in the future. One of the things that you're going to continue to see associated with all three of those items is potential growth, as it is associated with the Inflation Reduction Act that was voted and passed this calendar year and signed into law by the current administration. Now, whether or not you agree with the law, it's important to note that this does provide a large tailwind to a company like STEM, who already is a market leader, and they have the capability to continue to have additional sales because people are going to be receiving tax credits associated with it. It also benefits them because it is a direct reduction in cost associated with the customer, and the company, or STEM, is in a very strong position already because they can go directly to all of their also energy clients, and they can essentially retrofit those systems to be incorporative of the batteries that they already have. Again, this is a large warm handoff or warm sale. These are not new customers, they're current customers that you can sell into, which is infinitely a lot easier than anything that you would expect to see from cold sales calls. The benefit here is that you're going to be able to continue to perform very well over the immediate future, as well as this information is not taken into account with the current financial projections. So important to note those items. The next two slides talk more about the battery supply chain as well as the pricing, both of which are fairly optimistic. They highlight supply chain could pick up or perform better, as well as they expect that it's going to have cost decline going forward. You can see that they expect essentially from 2023 to 2031 are going to continue to decline. Something that I would call out here is that while they have fully contracted through 2023 or Q3, they're arguing or looking for additional agreements to lock in their supply chain. I think that's great, it's beneficial, but I think that this is optimistic. Based on where the industry is going, whether it's auto, whether it is solar, whether it is any number of different items, I think that battery prices may struggle to see large-scale price declines on a go-forward basis due to the supply nature unless we see large increases in demand. At this point in time, I don't see that occurring. However, obviously STEM is going to have a lot more individuals in the space than me, who's a armchair economist and likes to provide their opinion on YouTube and on Twitter. That being said, I will continue to monitor this because I do think that if those battery prices continue to increase as they've done over the past 2 years, you're going to see that negatively impact overall profitability associated with the larger hardware contracts, which have the smaller amount of gross margin associated with them, especially net margin. So on a go forward basis, again, I'm going to walk through or scroll past a lot of the information that you see here in terms of the market outlook. But it's important to note that in terms of some of the capabilities going forward is the solar market is going to continue to benefit from battery technology and battery storage because solar cannot always be optimized without storing some of the excess energy. At the point in time when the solar panels are performing at greater than 100%, in terms of greater than 100% of what the energy is needed, that energy has to be siphoned off somewhere. Might as well put it into battery tech. And if that tech is subsidized through the IRA Act, then you have the capability to see the potential benefits from STEM. Also, they have the capability to currently sell into their own base. You can see in California, Massachusetts, and New York. In particular, California and Massachusetts, STEM already has a strong presence, so I think that this would be highly beneficial from them. I also note that I scrolled past a important slide here in terms of the e-mobility market outlook. My personal opinion on this, feel free to push back on me in the comments, is that this is more of a buzzword type of item. STEM historically has not been heavily involved in fleet mobility or in electric vehicle optimization. That's not to say they won't in the future because they do have a few contracts, but I think right now this is more of a buzzword. It's more of a hype up component of their overall strategy versus one of the main component that they are growing. And you can see that it's so much not of a big market for them currently that it's not even included in their current market outlook because it is more of a potential where they're well positioned versus something that's actively in place today. So moving forward in terms of some of the capabilities of the company, I'm going to highlight, I think that the overall storage costs are going to continue to be a pain point for profitability, but continue to grow from a revenue perspective. This is something from an EV fleet that it's a maybe in my opinion. However, wind capabilities is another kind of, all three of these are like, yeah, I see the potential, but it's not something that they've done historically. However, until they or as they continue to develop their current market share and as they continue to identify potential bonuses, I do think they have the capability to benefit incredibly well, especially if you see some of those battery costs drop. So as we scroll through here, I'm going to kind of skip through some of the also energy information as well as the technology. I'll reiterate for a third time, feel free to check it out in the slides for yourself. What we do want to do is focus on kind of how this benefits companies. You can see C&I facility, commercial and industrial. Basically, they have the capability to immediately save energy. However, they also have the capability to sell some of it back, as well as charge fees or reduce fees from their current provider. So that's obviously the value add in terms of the company. What we want to focus on next is the profitability metrics or the financials. So Bill Bush has been a big seller of Tesla stock, as have a number of individuals here. And I think I may have said, so something that I want to call out as we're looking at the information here associated with the CFO, a number of the individuals in this presentation have been selling a significant portion of their shares. There's a large part of insider selling associated with STEM. You have to remember that the company or these individuals got significant stock options prior to even going public. They're going to continue to take those wins. They also continue to receive large stock options. So if they sell some today, they'll get some more tomorrow, assuming they continue to execute appropriately. And third, due to the overall market environment, I understand why people want to get out while the getting is good, and I expect that to continue to occur. That being said, until we see some major players exit all of their holdings, that's when I'm going to begin to get worried. Insider trading is a continuous part of stock purchasing and selling, especially when your company continues to be valued very comfortably. But it is something that I don't want to be the one left holding the bag. So it's something that we're going to continue to watch. So that was a side note, but let's dive into the financials because I think that it is important. They continue to grow incredibly well. You can see that in the operational performance here, but from a capital structure, this is what I really want to highlight because I think that this is massive, is that they did raise a significant amount of money, but more important than that, they were essentially able to lock in $500 million of cash with a 0.5% rate. I think the total interest due on those is around 1%. but the capabilities of raising significant amounts of money on a very, very low interest rate means that they basically had some money to play with, including the purchase of Also Energy. It's important to note that's not included in this presentation, as they did approve the potential to sell additional shares, and if the company continues to maintain a very attractive stock price, I would not be surprised to see them further dilute some of their shares by purchasing or releasing additional shares of stock. Because the stock continues to perform well, it's over the SPAC price, and if you can raise cheap cash going into a potential recession, it makes sense from a financial perspective. However, that will be painful for the stockholders. They have the capability to sell as many as 600 million shares. I haven't seen any news of that in the immediate future. However, I think that it's definitely a possibility on a go-forward basis, and you need to make sure that we're watching that going forward. Now, going forward, speaking of, they're continuing to grow. I don't have concerns on their growth metrics. Their backlog alone on the booking side is massive. I do have concerns about profitability. Now, some of this I think is going to tie into the predictability, where they are investing in recurring revenues, especially on the SaaS side with their software. However, they've got to maximize margins from that and continue to perform well on the hardware side so that they can get a stronger percentage of the profits on a go-forward basis. They continue to say that they are going to be EBITDA positive in the second half of 2023. So we need the 2023 numbers to be positive. And I'd like to see that the capability to be overall net income positive is not due to stock-based compensation, which they continue to maintain a very high cost associated with it. It's important to note that they have released, as part of this presentation, 2025 financial targets. We haven't seen these since the SPAC presentation. They continue to show that they have very strong margins. I'd highlight these are non-GAAP, which means that they're not inclusive of fixed costs like stock-based compensation. So I need to make sure that when we're targeting these 2025, yes, these are going to continue to grow, but is that margin going to be profitable from a GAAP perspective? Because right now you're showing adjusted EBITDA, and I really need this to be just EBITDA. Otherwise, you're going to continue to see potential pain in the stock if they're not able to say that they're going to be profitable in 2024, which was the original projection. If they are not profitable over the next 2 years, I do expect them to dilute the stock further, which could obviously have negative implications associated with the overall share price. So this is a super important slide, and I can't say that I'm loving how exciting it is, largely due to the fact that I see adjusted EBITDA here, which is not a fun term. It includes a lot of, basically they can make up the number, and I don't like the non-GAAP gross margin. So I'm calling both of those out today on October 9th, 2022, and we'll see where this is a year from now or 2 years from now. Some of the ways that they plan on doing this is obviously reducing cost, increasing benefits, and they've got a lot of different capabilities they're looking to target on a go-forward basis. So they've got a ton of information in here. I'll showcase and kind of close out with what we see here on the screen. They're expecting adjusted EBITDA to be fairly negative. Again, adjusted. This is my big worry, is because they have a large component of stock-based compensation, and I think that the company for 2022 could see them burning through more than $100 million, which obviously is not going to benefit the overall stock or share price of the company. So there's things that I'm concerned about. Obviously, the revenue and bookings growth is insane, but I don't see a clear path to profitability in the share price, and I'm not really interested in owning a company that has no interest in being net income positive within the next 2 to 3 years, and I'm not seeing that right now. But again, I continue to be bullish on these numbers, and I'd like to see them kind of tone down some of the information or noise to get to be profitable. So you can see these items here. I'm really excited about where the overall growth of the company is doing. The management team continues to execute. I just want to make sure that the shareholders are also getting to benefit from some of the success of the company. Because this has been a very long video, if you made it this far, I really appreciate it. Let me know if you have any thoughts, questions, comments, whether it's in the comment section down below or in the Discord, which is free to join and in the description. We have a channel dedicated to STEM in there, and we talk about it fairly often. So if you've made it this far, thank you for watching. Please leave a like and subscribe, and I'll talk to you later. See ya.